Hello. So for today we have the topic. We are continuing the topic of asset-based lending, and for today we are going to discuss about some disadvantages. Last topic that we discussed was the advantages of asset-based lending in the previous video. This video will have some about the disadvantages, and then you will be seeing at the different structures of asset-based lending. It can be like a term loan or a revolving line of credit that we will discuss about, and we will discuss a little on the risks associated with asset based lending. So let's start with the disadvantages. That it can present disadvantage for the borrower and the lender. For the borrower, an ABL is often more expensive. So whenever you take a loan, then you have to pay some interest rate on that. So and sometimes it can be a higher as compared to other types of lending thing. In this book, like handbook, we have not mentioned that what are the other lending like options that we are comparing with for the ABL, but this is what is written in that. So you have interest rate and loan fees. There can be some loan fees as well when you are taking some loans from the ABL structure, and they are generally higher, and costs associated with the frequent reporting requirements greater. Another potential disadvantage to the borrower is that the loan agreements typically allow the lender to take control of the borrower's cash or more steadily seize the collateral if the borrowing base declines to a level that does not support the loan. So this is one important point that we have to emphasize more on, that the lender gets the control on the collateral that is pledged to take the loan on, right? So they are more having control. It really sees control collateral. They can also take the collateral completely if the borrowing base declines to a level that does not support the loan. So the like in summary, in short, what does this mean? That the lender has the full control of the stuff. That's why this is a disadvantage to the borrower as well. For the lender, the administration and monitoring of ABL is time and cost intensive, and particularly susceptible to borrower fraud, especially when a business experiences unpredictable cash flows or financial troubles. This line means that the lender has to continuously monitor the business of the borrower, because if anything changes in the business of borrower and they are defaulting a lot and are not able to pay back the loan that they have raised, so it will be like time and like cost defaults or some negative effect on the lender side. So this is one of the disadvantages that we have. Let's go to the ABL structures that are possible. We are going to discuss. So the revolving line of credit or the revolver is the most common type of ABL. ABL, when I say that means like asset based lending, collateral based lending, and we are saying that revolving line of credit means that whenever the borrower wants to raise some money, they will be able to borrow on the requirement basis, and they can be able to pay it back on whenever they want to pay and however they want to pay. The facility allows the borrower to draw funds, repay the draws, and redraw the funds over the life of the loan. A revolver is commonly used to finance short-term working assets, most notably inventory and accounts receivable. If they want to give some loans, they can use the revolver side, or if they want to buy some inventory for their like actual production workflow, then they can raise some money using this revolving line of credit. The cash from the sale of the inventory and the collection of receivables is a typical source of repayment. So either they can repay the inventory that they have, so that inventory gets converted to a cash side, or they have like accounts receivable, they get some cash payment afterwards, so they can use these to repay the revolver. A borrower that has substantial working capital needs, such as wholesaler, distributor, or retailer, frequently uses revolving credit. If they want working capital, high need of working capital, so they can use the revolving credit. A service company may also rely on a revolver to fund the accounts receivable. Simple. A revolver is generally secured by working capital assets such as accounts receivable and inventory. Working capital assets. This is one thing that I am always getting confused on, that what is a what is the definition of a working capital asset? Let's see about this more. Working capital asset. Google Chrome is very good. Whenever open I Microsoft Edge, I just get like here and there, and I don't get the perfect answers. Working capital meaning is the money a business uses for its daily operations. It is found by taking all the short-term assets and subtracting all short-term debts. So it is like for the daily operations, whatever money that they have, that is what the working capital means. A revolver is generally secured by working capital assets that we discussed. The value of the underlying assets determine the loan amount. Yes, so the loan amount is based on a collateral, and collateral is the underlying assets that we're talking about, so that the value is like connected to the loan amount and the availability of funds. In some cases, a minimum amount of availability, often referred to as hard block, must be available at all times. So like a minimum some availability of the collateral should always be there. So that is what we are talking about. Typically, a borrower can draw against the revolver as many times and as often as needed, up to the lesser of the available borrowing base or the revolver commitment amount. So the borrower can actually draw maximum, like the facility limit that is set during the loan starting, or they can also borrow on the basis of what is actually borrowing base set on the basis of collateral that they have. The outstanding balance of the loan should fluctuate with the cash needs of the borrower, subject to the availability constraints of the borrowing base. The outstanding balance of the loan should fluctuate with the cash needs of the borrower. Right, the borrower needs cash or money, they will take the loan, and it will affect the outstanding balance of the loan, and subject to the availability constraints of the borrowing base. And this is always based on what the borrowing base that they have, or what is the maximum eligible loan that they can originate based on the eligible receivables and the cash that they have. Credit availability is restored when principal is repaid from the conversion of assets to cash and collateral stored to the borrowing base. Credit availability is restored when principal is repaid from the conversion of assets and restored to the borrowing base. Yes, this means that whenever they repay some amount of the loan from the borrowing from this credit facility or revolving line of credit, this again reduces their outstanding loan, and this again increases the borrowing base that they can take. So the borrowing base again increases, so that they will be able to originate more in future. The borrower must comply with the terms and conditions stipulated in the loan agreement, including the lender controls and the treatment of cash proceeds for credit to remain available. In general, cash conversion proceeds are applied to the outstanding balance of the revolver when received. This is commonly achieved through a lockbox arrangement whereby the lender controls the borrower's cash receipts. This is a little tricky. What I will do, that I will just highlight this and will create a different video on this like doubtful stuff. So that highlight. Okay. Yes, now let's go to a different thing on the revolving line of credit. And over advance may be a part of a revolving line of credit, and over advance is a loan advance that increases the loan balance beyond the amount supported by the borrowing base. So this is something new, that you have a borrowing base of, for example, 100 million, and you want to take some extra loan on that. That is a temporary basis you want to take some loan. So the lender can agree that we will give some over advance to you. And the primary source of repayment for O is typically the company's operating cash flow. As the company moves, they generate cash or net income higher than zero, and they can repay this over advance also. So that is the main source of repayment of the over advance. The ABL finance facilities may include a pre-approved seasonal over advance for a brief period during the normal operating cycle when seasonal inventory buildup exceeds sales. Yes, so this is what I told, right? That over advance is for a brief period. It is just a temporary basis that the lender is ready to pay some extra on that. In this situation, the bank increases the availability under the borrowing base for a defined period before the peak selling period. For example, a lawn and garden equipment manufacturer may require additional credit availability during the winter months when sales are slow and inventory is accumulated for spring shipments. Over advances also extended for other purposes such as to take advantage of the trade discounts or to finance other like assets. So it can be like used for anything that the borrower needs, but it is the main point is that it is for the temporarily extra advance that the borrower is getting from the lender. Then you have a revolving ABL facilities are of sometimes structured with two tranches that each share a senior lien on the collateral but have different repayment priorities. In this structure, the senior tranche is often referred to as the first out tranche, while the junior tranche may be known as the last out tranche. As the name implies, the first out tranche is senior to the last out tranche with respect to repayment and receives all principal payments until the first out tranche is fully repaid, after which the principal is applied to the last out balance. Although the structure may vary, the last out tranche is typically dispersed all at once with no repayment required until the loan matures or the collateral is liquidated. The last out tranche provides additional financing to the borrower by allowing a higher overall advance rate, while the lender benefits by receiving a higher rate of interest on that tranche. A revolving ABL facility may also be structured using a second lien loan to provide additional leverage. Second lien loan is similar to a last out tranche in that it is subordinate with respect to repayment but does not share a senior lien. A second lien lender's interest is typically governed by inter-credit agreement that gives the first lien lender greater control with respect to the collateral. So here we have like multiple topics attached together. So what I did, shit. Okay, wait. I guess I'll get the point. I made it very clear yesterday that I wanted to understand this topic very well. So these different terms are very much confusing along with each other. So I made it very. See, this is the ChatGPT chat that I'm looking into, and let's see where it went away. Discussion of different one important discussion. Cash types overview. Just 1 second. Yes, here we got that point. Yeah, there are multiple topics, like multiple terms actually, which are like confusing a little bit, but they can be understood very well. You have a borrowing base, the main borrowing base, then you have a over advance, then you have supplemental borrowing base. This is regarding the amount that the borrower is raising. So this is the amount borrowing. The borrowing base is the normal amount that is already collateral based and someone is taking it. Then you have an over advance and supplemental, that are some extra advances that we are taking from the lender. So that is the amount side. But these terms that are first lien, second lien, subordinated debt, and last out, first out, these are based on the priority of the payment that is there. So whenever a borrowing base is first lien or senior debt or senior like tranche, something like that, so in that case what it means that whenever the repayment of these liabilities will happen, this will be the first liability that will be paid first. So that is how these things are. I will, if you tell me, or you can comment below, or you can email. If you find the email from my channel description, you can mail me so that I can send this whole ChatGPT stuff to you, so that you can read and understand what I was talking to and what was my mindset. And I clarified in multiple loops, so that will help your understanding to actually grow. Next is the last topic, that is the term loan stuff. The banks frequently make term loans to ABL borrowers. Term loans commonly finance capital expenditure with the finance assets securing the loan. In ABL financing, however, term loans may be a part of a large structured financial transaction that combines ABL with other secured or unsecured debt. So in this, like this term loan, in which it is not like a revolving line of credit, it is just a big loan that is given to a borrower. So yes, today that was the discussion of the borrowing base and understanding of the borrowing base, and we will learn more in the next few videos. Thank you if you stayed till here.